Good evening. This is the lecture video for chapters 9 and 10 for international economics. Welcome. This is Friday evening, so it's already past my normal work hours, but I have family in town this weekend, so I decided to get this done tonight. So casual Friday. Again, hope you don't mind since it's already Friday evening. Um, anyway, so before we begin, just a quick recap of the announcements we made this last week, both in the video and during the class. Your second exam is next week, um, going from the 17th after class all the way through the 20th, Saturday evening. Okay, so please start reviewing chapters 6 through 10. Be ready for these questions. And on Wednesday when we have class, we will talk about chapters 9 and 10, and I'll answer all your questions. Then we'll do the quiz for these two chapters, and then after that, the test will become available to you. Okay. So just keep that in mind. Now. Chapter 9 is the last chapter on international trade, and it starts to transition into international finance. And Chapter 9 is about the factor movements and multinational enterprises. Okay, so it's important for us to understand international factor movements because when it comes to international trade, goods and services only account for a part of international trade, and the rest is all movements of resources and investments. And so if we only focus on goods and services, we're really not seeing the whole picture. And especially nowadays with more and more corporations that exist in multiple countries, we call M&Es, or the multinational enterprises, and they facilitate a large volume of transactions and trade in factors of production and investment or money. Okay, so now to a multinational enterprise, you can understand that's a corporation that operates in many different countries, and oftentimes they have businesses that expand in different markets, not just one type of product, right? So that kind of leads us to the question of integration. Okay, integration is when companies kind of combine different aspects of production together, and there are three types of integration. Okay, the first kind is called a vertical integration. A vertical integration is when a parent company establishes subsidiaries to produce some intermediate goods or inputs that go into the finished goods. For example, if let's say Chevron buys an oil field in North Dakota, that is a vertical integration, right? Because they're getting the oil for their gas stations to distribute. So Chevron, what we see Chevron do is sell gasoline on the streets at their gas stations, but if they purchase the upstream product of oil, then that's called a vertical integration. Okay. Another example can be, if Ford purchases an engine company and makes it part of their operations. They make their own engines that go into their own cars. That's also vertical integration. Okay. Now, the next kind is called horizontal integration. Okay. Horizontal integration is when a company starts producing the same product in a different market. Okay, so for example, Coca-Cola has production in America, in China, in Mexico, in pretty much any country in the world, right? India. But every new market they go into, it's the same product. They make the same soft drinks that they offer, especially the Coca-Cola drink itself is offered throughout the world, right? And so that's called horizontal integration. They just kind of expand the same market to different corners of the world. And then finally, the last kind is called conglomerate integration. Okay, conglomerate integration is more interesting. It's when a company that decides to go into a completely unrelated market than what they originally were producing. Okay, so for example, Michelin is known for producing tires. Okay, but they're also the biggest name in food ratings or restaurant ratings in the world, right? So many of you have heard of, restaurants earning Michelin stars. It is the same Michelin, same company. Okay, so what happened was, 100 years ago or so, Michelin was selling tires, and back then, not a whole lot of people were driving, so they were trying to figure out ways to get people to travel more, to drive more. So they came up with this idea of, hey, what about, that was pre-internet days, right? So what about we go out, find interesting restaurants that people can visit, and then we'll rate these restaurants and then tell people about how good they are, what are their best dishes, and etc. Then we publish this pamphlet and booklet and send it to households. Maybe that will intrigue people to go check these things out. So that's kind of how it got started, and it was to help their original main product, but it's establishing themselves in a totally unrelated different market. And after decades of doing this, Michelin has become the biggest name in these restaurant rating market, right? And any restaurant, even if they earn one Michelin star, you can earn anywhere between 1 and 3 Michelin stars. And 3 Michelin stars are like the unicorns of the restaurant world. There are very few throughout the world, and many countries don't even have one. And those that do have some usually just have a handful. And so, but even a 1 Michelin star restaurant is highly regarded as a good place to visit, right? I've only been to one in New York City, and that's because that restaurant still is holding their prices fairly reasonable, right? And if you go to a 3 Michelin star restaurant, that's when you spend hundreds and hundreds of dollars for the experience, and they know they can charge that because Michelin said they're worth it. Right? So, but anyway, so that's an example of I can't talk. I really can't talk now. Okay, yeah, you know what I meant, right? Conglomerate. All right, I'm having trouble. Okay, moving on. Okay, must have been a long week. Hopefully, you guys are not laughing your heads off. Okay, all right. Now, when these companies integrate, these multinational corporations do their integrations, whether it's vertically, horizontally, or I cannot say that word all of a sudden. Man, there must be something going on with my brain. I'm sorry. But anyway, so they have to have investment put into other countries, right? So when there's investment coming directly from another country into a second one, we call this type of investment the foreign direct investment, or FDI for short. Now, there are many different benefits for having FDI, okay? Because you can first of all have more funds available to expand production in your country, and that comes from from a different country. And also, if they put money in here to expand their production, that means you can have more jobs available for your local residents, and more tax income, and more income for your workers, which in turn stimulates consumption and etc. Yeah. Conglomerate. Finally, I can say it. Okay. All right. That was a 3-minute struggle. Okay. But anyway, so FDI, or foreign direct investment, is very helpful for any country that receives them. Right. So as a result, countries all desire to have these. Okay. Now, when it comes to deciding whether a company decides whether to go into a foreign country to do FDI or not, there are a number of factors that they consider. Okay, in general, the motivation behind this is that they view their investment can generate high rates of return, or maybe they can receive more income by expanding into a new market. So they consider um, both demand and cost factors. Okay, some general demand factors including whether the new market is worth it, right? Whether there are enough sources of demand, and whether you can tap into the foreign markets uh, that can adequately maintained by exports, and if not, then you want to then set up shop there, right? So, and also you consider whether your production can sufficiently satisfy your domestic demand. If your production capacity is higher than your domestic demand, then you might have extra production you want to put into another country. And also you consider if there's enough market competition there. And so those are the demand side factors that firms consider. Now, cost factors, okay, when you decide if you want to go into another country or not, is, well, will going into another country reduce your production costs? Okay, and do you have enough raw materials for your production that you can acquire locally there, right? And do they have cheaper labor? Okay, and do they have the infrastructure for transportation? And if so, are the transportation costs reasonable? Right? Are the government policies going to create any headaches for you, or that, for example, high taxes, right? And whether you can gain economies of scale by directly exporting into a country, or licensing a local producer to produce your product for you versus building your own factory, right? So whether it's worth it or not. So those are the factors that we consider when a company decides if they want to perform foreign direct investment or not. Now, a common case, okay, is the last thing we mentioned among the cost factors, which is, well, if you decide, okay, I want to go into this country, okay, then a very common decision then to make is, okay, do I want to set up shop myself by building an entirely new plant and set up everything in that market myself, or do I want to just find a similar producer and give them the permission to produce, and give them the technology to produce my products for me? Okay. For example, in China, Nike and Adidas, these big shoe producers, have licensed local producers to make shoes for them. Now, we talked about before that China has a big issue with intellectual property rights. And so what has happened was, after 20 years of making shoes for Nike and Adidas and these big names, these local guys have learned how to make very high quality shoes. And they've then moved on to some created their own brands, and some ripped off Nike brands and made the shoes. If Nike ordered 1 million pairs, they would make 2 million and then give Nike 1 million and then sell the other million directly themselves as Nike, right? So sometimes this is granted and permitted. Sometimes Nike is not aware that there's an additional million hitting the market in China at half the price. But after years of practice, these guys actually can make very, very high quality shoes. And in fact, there were some documentaries trying to talk about this, and the top of the line shoe experts cannot tell the difference between a counterfeit pair and a real pair. And then in many different kinds of tests, kind of torture tests of these shoe qualities, the counterfeit actually win. They're better in quality now. But anyway, that's a side topic, right? So the point is, oftentimes the decision is between whether you should license somebody to do the work for you and not worry about setting up shop versus you going in and doing everything from the ground up. Now, that decision really lies in how big the demand is in that market. So let's look at how that works. Okay, so if you look at the foreign market you're considering entering, okay, so there are the things you need to compare is that, well, think about if you set up shop, okay, that means you have to put down a lot of fixed costs. You have to build a factory and bring in all the equipment and etc. and train your employees and hire new people, right? So these are all high fixed costs. So what's going to happen is that you're going to have a average total cost curve that starts high and then eventually maybe will go. So this is going to go up. So this is ATC with directly investing in your own plant. Okay, and that means your average variable cost is going to look something like this. Okay, and you're going to also well, the difference between these two curves, the vertical difference between these two curves is then your average fixed cost. Okay, so this is a concept from Econ 150. If you don't remember, maybe you can review this quickly from your old notes or something. Okay, now, so this is what happens when you have a subsidiary set up or you go in for direct investment by building something. Okay. Now, if you were to do a license, okay, then there is no fixed cost, and all you face is the average variable cost, right? Because you don't have to put down any factory buildings, any machinery, and do any raw material and all that, okay? You can just tell a currently functioning producer, hey, why don't you produce under my license? I'll give you the formula. You know, maybe it's a Coca-Cola, and then say, hey, I'll give you the formula. You can make it, right? So all you face is the average variable cost, the cost that is generated with your production. So let's say that your average variable cost for the existing producer looks something like this, right? So AVC of licensing. Okay. Now you can see that this doesn't start nearly as high as your average total cost for direct investment or building a subsidiary because there's no fixed cost to put down. So now the question is, well, what should you do? Okay. That really depends on how high the demand is in this market. You can see that these two curves, okay, because the AVC, the red line, is all you need to consider if you license. Then the ATC is what you need to consider if you build. So let me change a different color, right? So wherever these two cross each other, this is the magical quantity, okay? So this is the determining quantity. I mean, I won't put a star in it because that's usually equilibrium. This is not equilibrium. But this is the magical quantity because you can see if the market in this country has a demand, quantity demanded lower than this quantity. Let's say here, so this is quantity of 1,000 products demanded. That's the magical quantity. But in reality, only 600 are demanded in this market. You can see at 600, okay, at this level, the cost of licensing is lower than the cost of building your own factory. So in this case, you should just license a local producer that already exists to make your product for you under your brand. However, if, let's say, the local quantity demanded is higher than that magical number right here, you can see then now the licensing cost is higher than building a factory. So in this case, it's cheaper for you to come in, build the factory yourself, and then produce your own product yourself. Okay, so the key is this quantity at which these two curves cross compared to actual quantity demanded. If the actual quantity demanded is less than this special quantity, you license because licensing is cheaper. But if the actual quantity demanded is higher, then that's when you build your own factory, build a subsidiary, and then because that large demand is worth it, it will justify the fixed costs you have to put down. Okay, so that's how you make that decision. All right, now, okay, then there are a number of other risk factors that big companies consider before they go into a country, okay? And your book talks specifically about this, and I'm just going to give you the general types of risks that they consider, right? They consider political risks, right? So whether the government is stable, if there's corruption, and whether there's a domestic conflict going on, religious tensions, ethnic tensions, right? These are all things that a company should look at before they start doing business in a country. And then there's financial risks, right? So whether the country's in a lot of debt, right? And how many local companies default on their loans, and whether the exchange rates will fluctuate sharply. And so these are the financial risks. And then they also consider economic risks, right? So that's, what is your GDP growth rate, and what is the per capita real GDP, so the standard of living, and how bad is the inflation rate, and unemployment, et cetera, right? So when you consider all of these, okay, then you can make an educated decision. Now, your book talks about how there is a composite country risk rating. Actually, this is a published source of information that many multinational corporations pay money to receive monthly. And this is a ranking of nations, and the higher the score, the lower the risk, the more stable a country is. And then the lower the score, the worse, and the higher the risk there is for a country, all things considered. Okay, so again, you can read about it pretty easily, so I'm not going to go into great details here. Okay, now, so let's look at foreign direct investment that we receive in the United States, right? And when foreign companies come and build subsidiaries in the U.S., we call those transplants. Okay, and we kind of talked about this before. Now let's look at it in a new set of eyes, a new perspective, I guess. So transplants, the reasons that foreign companies are willing to do that in the U.S. can be a fairly good list, right? So, for example, I haven't watched this documentary myself, but I've heard of it. The Obamas saw this documentary that they put on Netflix called American Factory, and it's actually about a Chinese factory. So the biggest auto glass producer in the world is a Chinese company, and a few years ago they made the decision to set up their plant in Ohio, and in a town that used to be pretty big into producing auto parts. Now it generated hundreds of new jobs and brought some auto workers back, kind of revitalized the local economy, but that doesn't mean there were no conflicts, right? So the biggest thing was a couple of years ago, the auto workers union tried to go into this factory and unionize their workers, and they have a 90-something% success rate in unionizing factories in the auto industry. But this Chinese company actually beat the odds and convinced their workers not to unionize. And but that was viewed as a huge victory on the factory's part, and it made national news, even international news, because the auto workers union is rarely defeated when they try to pull this stunt. And but anyway, so this documentary talks about the process of coming together, because the expectations from American workers were quite different than how the Chinese management would run things, right? But the point is, well, why did this Chinese company build a factory here and build a transplant? Well, first of all, okay, by coming here, they could silence a lot of critics who say, well, we shouldn't use foreign parts in our own American-made products. Okay, but also that means they can have greater access to their biggest market, right? Because America was their biggest market. So by coming here, they can easily ship their products just by train to Ford and GM and all these big producers without having to, having to wait for weeks shipping through by boat, and also then they can avoid import barriers because their product will be now made in America. Okay, and then another thing that we will talk more and more of as we go on is that by coming here and selling their product directly here, then they avoid or they hedge against any fluctuations of the exchange rates. Okay, for example, in the last 2.5 years since we started the trade war, the Chinese yuan has really depreciated. If they had been selling their products in China to America and receiving yuan as payments, then how much they received would have been probably worth less if they got caught in the fluctuation of exchange rates. But now, being in the U.S., they can just conduct business in American dollars, so that it alleviate some of the pressure, financial pressure from exchange rates fluctuations as well. Okay, so that's kind of why we do it. But of course, the benefits to the U.S. is then it generates jobs locally in the United States, and hopefully it'll expand consumer choices here. I'm talking about in general, not just with that one plant alone, right? And maybe if it's something that we didn't know how to do before, then that can transfer the technology here, kind of like the Nike shoes with those Chinese producers, right? So both countries can benefit in this scenario. Okay. Now, sometimes, okay. When you want to go into a different country for various various reasons, a company might not want to do it alone. Okay, and so that leads us to this topic of international joint ventures. Okay, so an international joint venture is when business organizations are established by two or more companies, and they come together to combine their skills and assets. Okay, and usually the objective is not a full new company, but rather they say, let's just work together for a period of time, and we are going to work on one or two things, and then call it good, right? So sometimes we create new firms and just make it stay, but the point is, okay, that's when you have two or more companies coming together to pool resources. And there are three types of international joint ventures. Okay, the first kind is when you have two or more businesses joining together to establish something in a third country. Okay, so maybe a Japanese company and an American company come together and then build something in China. Okay, so that's the first type. The second type is when you have a joint venture of companies with local private interests. So let's say that's when Sony and Vizio come together and then join with a Chinese company and building this joint venture in China. Okay, the third type is when you have a joint venture with the local government as part of the deal, okay, where you partner with the local government. So Sony and Vizio come together and then working with the Chinese government to set up something for them in China. That would be the third type. Okay, so now some justifications or motivations for doing this, it can be, first of all, sometimes the cost of doing something might be too high for one company to bear, so they can find interested parties to come together and share the cost or share the risks. Okay, and sometimes it's required by the local government. For example, the Chinese government up till just earlier this year, or no, I guess the later last year, did not allow any foreign company to independently exist in China and owning their subsidiary in China, especially in industries like finances. Okay, now as part of the new trade agreement we had with China, the phase one or stage one trade agreement we reached with China last year, as part of the deal, China agreed to finally allow foreign companies to independently exist in the financial industry. That's when, Morgan Stanley and JP Morgan and Goldman Sachs, these companies got all excited because they can now finally enter China without having to partner with a Chinese company, which was required by the local government, right? So that's another reason why they had to do it, okay? And also sometimes, companies don't want to be seen as this monster, giant corporation, then taking over a country's economic influences and then becoming, this political influence that everybody fears. So they say, hey, how about we go in this together so nobody will accuse us for running this country behind the scene, right? But anyway, so there are a number of reasons that international joint ventures should happen. Now, the advantages from having this is that, first of all, okay, you can have productivity and welfare gains. By joining together, you can increase your productivity capacity or productive capacity, and you can have, enhanced new markets that neither parent company could enter independently and handle, right? Or you can have a reduction of cost because of economies of scale by joining your production together. Okay, so, but of course, there are downsides for doing an international joint venture as well, right? First of all, you're going to have some kind of cumbersome organization, right? And you'll have divided control, and you probably won't agree on many things, and that might create a deadlock if you are 50-50. Okay, a negotiation can be very complicated when you have to involve more than just one party. Okay, and it can also lead to a possible welfare losses. Okay, so now, since this does happen, so let's look at just graphically of one possible reason why companies do it, right? So let's say that a Japanese, so Toyota and Ford, let's say initially compete for the Chinese market, right? So let's say that this is the Chinese demand and marginal revenue curve for the Chinese car market. Let's say initially, okay, Toyota and let's make things simple. Say this is the marginal cost, which is the same as average total cost for both Toyota and, for both Toyota and Ford, okay? They have identical production costs in China, and they sell their cars for $20,000. And because they compete against each other, they produce where their ATC crosses their demand curve, right? So let's say they each make, 10,000 cars. Okay, so 20,000 cars total, sold in the Chinese market at $20,000 each. Okay, now let's say if they were to join their productions together, form a joint company in China, then let's say because of economies of scale, they actually lower their marginal cost. Okay, so this is the marginal cost for the joint venture. Okay, so that is the first benefit. First of all, they decrease their cost, but Okay, let's say this also equals their ATC, just to make things simple. But also, okay, now since they're not competing against each other, let's say they've gained enough market power to behave like a monopoly. So now what they can do is they'll produce right here, where they'll produce 8,000 cars total instead of each, right? And then they can charge a higher price of $25,000. Okay, so the point is, okay, with a joint venture, now they can make a positive economic profit, right? Their economic profit is, again, your economic profit is price minus ATC times quantity, right? So price is 25K, ATC is down here, let's say this is 10K, so the difference between 25 and 10,000 times the quantity, this is their positive profit now. Previously, when they were competing against each other and producing right here at point A, okay, their economic profit was zero because the price of 20K equals their ATC of 20K, right? So now they have positive profit, a lot more profit to make. So this is one reason why companies might want to have joint ventures. Okay, now having all these multinational enterprises can create a lot of issues, as you can imagine, right? So some of the problems can be, concerns of national sovereignty, and also whether there's technology transfer or not. So, for example, in China, the government requires the foreign companies who come and into their country to transfer the technology after a certain number of years of selling in the market. So that can be, causing a lot of concern in the home country. Okay, and also having a large corporation that exists in multiple countries can create, problems with taxes, right? For example, a lot of big American companies are accused of not paying enough taxes, right? Because they can easily change their headquarters and where they file for their taxes to avoid higher tax rates. So the U.S. accuses Apple for not paying enough taxes, right? And Amazon and etc. and Google. And also there are tricks that they can do to evade paying or avoid paying, taxes, I should say, because one thing is called transfer pricing, where a company, especially when it's vertically integrated, they can write off their own cost for materials made by themselves, right? For example, let's say if BP, British Petroleum, owns an oil field in Texas, which they do, and then when they ship their own oil from Texas to Europe for refining, and then they sell their petroleum or gasoline in Europe, they can say, well, this batch of oil, sure, the international price of oil is, $42 a barrel, but this batch cost us $80 a barrel, okay? And now, even though that's their own production, they can write it off and say, that's my cost, so I don't have to pay taxes on it. And so they can avoid taxes by doing transfer pricing. So these are all kind of, concerns about large corporations, okay? Excuse me. And now another thing is that when we look at factor flows or factor movements and involved with different productions, is the effects of labor movements on incomes in different countries, right? So here I'm going to use the example from your book about what happens when Mexican labor comes into the U.S., right? So let's say that, well, initially, okay, this is the labor market, so the price is your wages, okay, and then the quantity is the number of labor, okay, so this is the U.S. Let's say initially, this is the demand for labor in the U.S., and the supply of labor is right here, okay. Now, supply of labor is vertical because, well, your labor force does not change dramatically. You can't just say, you can produce more workers overnight, right? So Mexico, Okay, same thing, wages, amount of labor, and their demand for labor. Let's say this is their initial supply. So supply of Mexico. Okay, first. Okay, or not. Now let's say that in the U.S. first, in the beginning we have 7 million workers, and in the beginning there's 10 million. Right. Well, yeah. So maybe not 10 million. Let's say each start with 7 million. Okay, 7 million workers in both countries, but in the U.S. Okay, maybe let's say people make $10 an hour, and in Mexico they make $4 an hour. Okay, and as a result, the area above. So let's call this area A, and let's call this area B, and then let's do area, C and area D here, So for A, this is U.S. workers' income, right? That's how much workers are making. 7 million workers making $10 each. That means they make $70 million per hour. So that's what A is, B is the U.S. capital owners' income, And so that is because, well, you can see that they are willing to pay more, but they don't have to pay more than $10 for the 7 million people they hire. So the difference is what they get to pocket. And so similarly, C is Mexican labor income, and D is Mexican capital income, assuming labor and capital are the only resources we have. So that's before any movement of labor. Now let's say that maybe we form a customs union, or no, actually a common market, I should say, with Mexico, where we not only have free trade, but we have free flow of labor. So that means some Mexican workers are gonna come to the U.S. because of the higher wages paid here. Well, as they come, then that means our supply curve in the labor market is going to shift to the right because we'll have more workers available. And in fact, I'll keep shifting right until, let's say 3 million Mexican workers move to the US. You have supply of US 1, so you have this shift. And now, because of them, as the higher amount of workers come in, wages gets driven down, and that goes down to $7. And in Mexico, because they lost 3 million workers, so now it goes down to 4 million, and oh man, that's a crooked line, sorry. So their new Mexico supply of labor looks like this, and they also reach a new price, a higher wage, because now workers are harder to come by, so business owners or capital owners have to pay higher for wages, and they will also eventually get $7 because, if the wages in these two countries do not equal to each other, then there will always be incentive to move around. The only time the incentive is killed is when the wages are the same. So as a result, the changes in these two countries will make sure that the wages in those two countries are equal. And this is also the biggest mistake I see people make when they do a question like here, right? If I ask you to show me the effects of labor movements on two countries, then people generally get the part where labor supply in the US is going to shift to the right and increase, and labor supply in Mexico is going to decrease. But then often they say, well, in the US, wages are going to be driven down to $5. In Mexico, wages are going to be driven up to $8, and then they stop there and show the effect. That's not going to be true, right? Because if the wages do not equalize in the two countries, then some Mexican workers will then move back to Mexico, and until that incentive is killed. So you always need to make sure when you do a question like this and show it graphically that the two wages in two countries after the changes will be the same. Okay, so that's a common mistake I see people make. So now let's look at what has happened. Okay, you can see for in the U.S. because workers have driven more new workers have driven the wages down, the capital owner's income increased from area B to this whole triangle. Okay, so capital owners are really happy about the incoming migration of workers. Now, U.S. workers will make only, let me change to a different color. So U.S. workers, local workers, will only make this much instead of, 7 times 10, they only make 7 times 7. So they lost this little box. Okay, so they lost this box, and that got transferred from U.S. workers to U.S. capital owners. So U.S. workers are ticked about having more competition. And then, Mexican workers who come in pick up this area in the U.S. So I'm going to draw it a little bit differently right here. Okay, so this area is what Mexican migrant workers pick up in the U.S. Okay, so they're happy about having this opportunity. Now in Mexico, the capital owners used to have the big triangle D. Now their income shrinks down to this part, so they lose, this area right here. Okay, and now they're new workers. They're workers that remain make this much, right? Because there are 4 million that remain, they make $7 each. So this becomes the workers' new income. You can see the middle box right here, right? The middle box right here transferred from capital owners to workers. They're happy, but overall they lost all this area that used to be part of their income, but now it's gone, not anymore. Okay, so these are the effects of migration of labor. Okay, and you can look at the example in your book, which is similar than this, and they mark the different areas by different letters and explain, and hopefully this makes sense. Okay. Now, the last thing in this chapter is talking about how the transactions done internationally by these big corporations and also the foreign direct investment affects the balance of payments, but that is actually the entire chapter 10. So instead of giving you a very brief introduction here, let's just jump to chapter 10 now and talk about balance of payments. Okay, so balance of payments, or BOP for short, is the accounting of a country's international transactions. Okay, so it is the record of all the economic transactions between the residents of one country and the rest of the world. As you can imagine, this is extremely important to keep track of, so we know how we're doing in our interactions with the rest of the world. Now, a couple things I want to introduce. This, like I mentioned before, this chapter is fairly short, and it's just laying the foundation for the rest of the semester about international finance. This is the first chapter on international finance. Okay, so first of all, the BOP account uses something called the double entry accounting. Okay, double entry accounting says each transaction is always recorded as a credit and a debit. So overall, the balance is always zero. Your BOP balance should always be zero. If it's not zero, that's when you have something off. Okay. So you might say, well, how can a transaction be recorded as both a credit and a debit? Okay. So that's the double entry accounting system setup. So let me give you an example, and hopefully it'll make sense. Now, the general rule for the BOP accounts is that any payment we receive is a credit or a plus. Okay, so you record that as a plus or a credit. Okay, so that's money coming in. So payments received. Okay, then any money going out, okay, so negative or debit is any payment we make and we send out. Okay, so any payment you send out to another country is recorded as a debit. Okay, now that's the general rule. Okay, when it comes to double entry accounting, so let's say that Ford just sold 1,000 SUVs to China, and in return, okay, they received, I don't know, let's say $10 million for it. Okay, so you have a $10 million transaction. Okay, now, first of all, this is a credit because Ford just made $10 million. Okay, right? So that's hopefully easy to understand. But in the same time, okay, when the Chinese buyers send the money, okay, so how things work with international transactions is that these Chinese buyers are very unlikely to just send a check or mail a bag of cash to Ford in Michigan, right? What they do is, well, Ford, let's say, has their main account with Bank of America, but Bank of America then has a relationship, a partnership with Bank of China. So what's going to happen is the Chinese buyer will deposit their $10 million payment into an account with Bank of China, and then eventually this money will be transferred to Bank of America's account for Ford. But the moment this transaction happens, that means now a Chinese bank is holding $10 million of US assets, right? Because the moment the Chinese buyer makes this payment and puts the money into the account with Bank of China for Ford, then that means there's now more American assets being held abroad. So that then is a debit because that is, U.S. asset, U.S. 10 million, okay, asset, no, never mind, I was right in the first place. Okay, held, okay, abroad. So we record that as a debit because more of our money is now being held by a foreigner. Okay, so then you add 10 million, you subtract 10 million, your BOP is still zero. Okay, so that's how the double entry accounting works. Now, for the purpose of this class going forward, okay, whenever I ask you how a transaction is recorded, only worry about the first part of this because we just understand at the end of the day your BOP should be zero. So we're not going to talk about how a debit counters a credit every time. When I say, well, when this transaction happens, how do we record it? I'm always talking about that first record and whether it's a debit or credit. And then again, the rule is follow the money. Okay, as bad as it sounds, it's the easiest way to keep track. If money is coming to America, then that is a credit. If money is leaving America, that is a debit. Okay, so that can simplify your life if you just remember that. Okay, all right. Now let's talk about the setup of your BOP account. Okay, your BOP account has two major sub accounts. Okay, the first one is called a current account. Okay, the current account records a number of different types of transactions. Okay, so first of all, okay, it records all merchandise trade. Okay, so merchandise trade means the trade of goods and services. Okay, so anytime we export, we record that as a credit in your current account because, okay, that's when we sell products abroad and we receive money coming to the US. Okay, and then every time we import a good or service, that is a debit because we're paying money to a foreign recipient. Okay, so that's the biggest part, and merchandise, and so goods and services. Okay, and then any income receipts or payments from assets. Okay, so what I mean by that is, let's say a U.S. Resident holds 1,000 shares of BMW stock, and at the end of the year, BMW sends a dividend check to this U.S. Stockholder, then that is recorded under your current account as a credit because, again, money is coming from Germany to the U.S. Right? That's an income earned by some asset U.S. Hold and U.S. Holds. And similarly, right, if a Japanese resident holds Ford stocks and then Ford sends them a check, then that's a debit in the current account. Okay, and then we have unilateral payments. Okay, so this can be made by the government or private citizens, but unilateral payments are payments that are going one way with nothing coming back, right? So that can be foreign aid, right? Every year, the U.S. government pays some foreign aid to some African countries to fight, malaria or whatever, right? Or the money we give the World Health Organization, or we used to give to the World Health Organization, right? Those are all unilateral payments. So those are recorded as debits in the current account. Or if we have migrant workers that send money home every month, right? They don't expect anything in return for that money. There's no transaction, just one-way traffic. So that is also recorded as debits in the current account. So these are kind of the what goes in the current account. Okay. The second type of sub-account under your BOP is the capital and financial account. Okay. Now some textbooks will separate the two and tell you there are 3 accounts under the BOP, but more standard is just combining these two, call it capital and financial account. So this one includes all the transactions of capital transfers. Okay, so when you buy a factory in England, that's going to be a debit in our capital and financial account because you're sending money to England, even though you're acquiring capital there. Okay, and also, yeah, any acquisition or transaction of non-financial assets. Okay, so for example, if Universal Studios paid J.K. Rowling's for the copyright of Harry Potter, right, or the right to make movies with Harry Potter, okay, then that is a non-financial asset, and the payment would be then a debit in our capital and financial account and recorded. Okay, then also, okay, any financial transactions of, for example, direct investment, Okay, so when when a company tries to build a factory abroad, okay, that's recorded here, and any kind of purchases of securities, okay, and then bank claims or other financial assets. Okay, like if you buy, if a U.S. citizen buys BMW stocks, okay, that purchase is recorded under the capital and financial account as a debit transaction. But once this person owns those stocks, any income they receive is recorded under the current account. So the purchase or sale of assets itself goes under capital and financial. Then any income related to those assets is recorded under current. Okay, so these are some of the main things that go under these accounts, and and then on top of that, you can have things recorded under this as what we call official settlement. Okay, so these are movements of financial assets from official holders like government agencies. So if the Federal Reserve sends some kind of financial assets to the British Central Bank, right? That's recorded under our financial and capital account as well. Okay, so that's the basic setup of the BOP. Like I said, just know the general rule is follow the money. If money's coming in, it is a positive or credit. If money is going out, it's a debit or a negative, and you need to know then which account is recorded under. And overall, because of double entry accounting, we want our BOP to be a big O zero at the end. Okay. Now, before we talk about more of the different accounts and balances, okay, one thing your book talks about that countries can hold related to the official settlement of central banks sending each other assets, financial assets, is something called a special drawing rights. Okay, so special drawing rights is a bundle of currencies that are weighted for, it's kind of like a mutual fund where if you buy a mutual fund, you're not buying stocks of anything specifically, but you're buying a bundle of different types of stocks, and you're just buying a share of that bundle, right? So similar idea with special drawing rights. So the idea behind this is, for the US, we don't think about it because our currency is desired by all countries in the world, so we do transactions very easily. But when it comes to small countries, right, and usually, unless they are trading with some close neighbor, nobody wants their currency, right? Nobody wants to hold, Malaysia's currency. I don't even know what it's called, right? Because it's too small of a country. So then, what they could do is, they could hold something that everybody desires, but sometimes it's hard for them to put all their eggs in one basket by saying, we want to have all of our foreign reserves in US dollars or all in euros and etc. And especially if they do trade with many different countries that have different priorities of which major currency they would like. So finally, the IMF created this special drawing rights, which is a bundle of currencies, namely US dollars, Japanese yen, British pounds, okay, the euro, and the most recent addition from just 3 years ago, the Chinese yuan. Okay, these 5 currencies have their fixed weights to form a bundle. They add up to 100%, and then small countries can say, hey, I know you don't want my currency, but here is 300 shares, my special drawing rights. Can I buy those F-35s from you now, right? Or Su-50 from Russia, right? Whatever the transaction is, and then countries are a lot more likely to do businesses with these smaller countries. And also, central banks can hold these as their currency reserves, a way to hold their wealth and shield themselves from wild fluctuations of the value of their own currency, because small countries also often face that difficulty, right? So that's what special drawing rights mean, okay? Now let's talk about, well, okay, when we have our balance of payments, BOP account, we said the balance should be a big O zero, right? But that does not mean the current account should have a zero balance, right? So what often happens is, well, if we look at our trade balance in the US, right? Our trade balance is a big O negative, and you've heard a lot about it. So since trade is the biggest part of current account, right? We just said merchandise and goods and services are all recorded under the current account. That means we have a current account deficit, big one, okay? Hundreds of billions of dollars a year. Now the question is, well, is this a terrible thing, okay? Because oftentimes you hear people say, man, the US is in trouble because look at that. Not only we have a big budget deficit, we also have a big trade deficit, okay? And they say this is doomsday scenario, right? If we can't, and then often a lot of people say, well, if we can't stop the budget deficit by disciplining our own spending, we got to at least get rid of the trade deficit first, right? We got to get rid of one at least, and then we can balance our trade, and we'll be better off. And in fact, this is the reasoning behind Trump's trade war, right? Because he looked at our trade balance and said, hey, wait a second, right? China, you sell to us a lot more than you buy. Canada, you sell more to us than you buy. Mexico, you sell us more to us than you buy from us. That is not right. So then he demands to have a balanced trade, or another word, a balanced zero current account balance with everybody. So let's talk about this, okay? First of all, to demand a balanced trade with everybody is insane, right? Ludicrous. Because every time you do a transaction, you are usually having an unbalanced trade. That's just the nature of trade, right? For example, let's say that, we're in phase 4, so everything's back open, and you take this hot date to Applebee's this weekend, and you get there, and when they serve you the steak you ordered, you look at it and you realize, hey, wait a second, this is clearly not $25 worth of beef, right? And so if you buy it, that means you have incurred a trade balance, right? You're buying something, you're paying more than what you're getting in return in true value. However, we accept it because we know we can then sell our skills or labor somewhere else and earn more money than maybe what we're valued at elsewhere to make up this difference, right? What you don't do is to say, hey, call your manager here and then point to this plate and says, hey, clearly this is not $25 worth of steak, so I'm at a trade deficit, and unless you pull out a painting and say, unless you buy my painting, I'm not going to pay for this dinner, right? We got to make sure this transaction is fair and balanced. We don't do that, right? And neither should we do that with every single country we trade with. So what's going on here is that we can have a big current account deficit as long as we have a capital account surplus, which makes our BOP balance to be the big O desired zero, we are okay, okay? And in fact, we do have a capital and financial account surplus. Here I'm just writing capital, but I mean capital and financial account, okay? We do have a big surplus in that. Our BOP is the big O desired zero. So there's actually nothing to worry about in terms of the whole picture. When we focus on trade and imbalance, we're really focusing on just one side of our economy and ignoring another. So what we've been doing successfully for decades as a country is that we've been financing the extra purchases we make of goods and services from other countries with the creation of new assets that we sell. Okay, so a trade balance means we're buying more from other countries than we're selling them. So how do we finance the extra purchases? The answer is, well, we've come up with new assets that we can sell to other countries, whether that's in stocks or bonds or factories. But the point is, we've been able to successfully create new capital and assets to sell, and that has funded us just fine. As long as we can make sure our economy continues to grow and continue to create such new assets and capital, we should not be concerned with the current account deficit. Okay, and moreover, okay, when it comes to trade deficit and budget deficit, they're actually very closely related. This is called a twin deficit problem. Okay, the twin deficit problem says, well, actually, your budget balance causes the trade deficit. I mean, your budget deficit causes your trade deficit in part, right? Not entirely, but in part. So the process goes follows, right? When we have a bigger and bigger budget deficit, that means our government needs to borrow more and more money, okay? Then oftentimes the only way we can attract more money for us to borrow is to increase the interest rate that we give on our bonds, right? Because when government borrow money, we issue government bonds, or called securities, and essentially IOUs, right? We say, you give me your money now, let me use it, I'll promise to pay you back 10 years from now with interest. That's essentially what securities are. But if we need to attract more and more people that are willing to let us borrow their money, then we often need to offer higher interest to attract them. Well, when we offer higher interest, we don't just attract American money. Foreigners who have money will look around and say, hey, I live in Germany. You know, in Germany, the interest rate is only 1%. In the US, it's 3%. So I'm going to just buy US bonds and earn higher returns, right? So when we borrow more and more money as a government, we attract foreign money. Well, the problem is a German citizen cannot just send the US government a check measured in the euro and expect us to send them some securities. We only want the good old green dollars. So that means that German citizen has to convert their money into US dollars first before they can buy our securities. So this generates then an increased demand for US dollars. Well, when the US dollars demand increases, then the US dollar appreciates. Okay, so the dollar becomes more valuable because more foreigners want to buy it. Well, the problem with an appreciating dollar is that when the dollar appreciates, US products will become more expensive to foreigners, right? The same $10 that they used to buy for our products now takes more euros to purchase. So as US products become more expensive, what happens to our exports? Well, exports decrease. And on the flip side, an appreciating dollar means foreign products are cheaper to the US citizens. So when foreign products are cheaper, what happens to imports? Well, imports increase. Now you have all been in Econ 150 before, right? So if if exports decrease, imports increase, what happens to your net exports? Net exports equals exports minus imports, so net exports is going to decrease. When net exports decreases, well, we call that trade deficit, right? So remember how we started? We started with having a budget deficit that led to more foreign money wanting to come in, which led to dollar appreciation, which then led to a bigger trade deficit. So this is called the twin deficit problem. Now, we cannot blame foreigners on our trade deficit, and trade deficit itself is not a problem. And if we actually want to fix it, one thing we can do is to discipline ourselves in our spending and rein that in to make our budget balanced, which of course will never happen. Right? So anyway, now I hope that makes sense. And the last thing that you can read more about is the U.S. dollar being the world's reserve currency. So that actually gives us a lot of advantages, right? One of which is that we don't have to jack up the interest rate a whole lot to attract foreign money. Sometimes foreigners just want to hold the U.S. dollars because it's a secure currency to hold, and which means we can borrow more and more money without getting into huge interest payments. And also, since everybody wants to have dollars, that again makes dollars appreciate, which means you can have access to cheaper foreign goods and more options. So there are a lot of different advantages to the US, and that's why we defend it so hard to make sure the world continues to accept the dollars. And that's why countries like, China or the European Union try to create influences for their currency to kind of topple the US dollar's world's reserve currency status, because then they can reap the benefits, right? So there's this battle between major currencies on who gets to dominate. But anyway, so that is the lecture on Chapter 9 and Chapter 10. I hope that makes sense. Write down your questions, and we'll talk about it on Wednesday. Remember that we will have the quiz for these two chapters at the end of class on Wednesday, so please study and make sure your questions are answered, and then we'll take care of that. Then your second test will be open. I will see you guys on Wednesday. Have a great rest of your weekend.